what I'm going to go through is latest data, updating our views on global liquidity and market outlook. What I'm showing here is end April data that we're just basically processing and about to release to clients. A lot of interesting trends that are coming through. As you can see from the title, what we're focusing on is very much the idea that there's an awful lot of cash out there, and it's basically filtering into different areas of markets and economies. And that's really what I want to explore, the outlook as we see it. For those of you that are new to this, let me just say a little bit about what we mean by liquidity, just as an introduction. The slide in front of you basically outlines the pool of liquidity as of the end of 2020. It's a pool of about $150, $160 trillion of footloose cash. It is vitally important for asset markets. I think anyone that denies that has been asleep for the last 12 months. It's the most important factor, certainly in our eyes, and it will continue to be. It may even get even greater importance as the years unfold. And as you can see, relative to GDP, it's roughly speaking about twice the size of world GDP. It's a measure, as we say in the text here, of balance sheet, the capacity of capital. It's not a measure of the cost of capital, which is interest rates. Interest rates, in our view, are a secondary feature. Interest rates matter in a world where capital markets act as new financing systems. We live in a world that's very different from that. We live in a world which is dominated by debt, where financial markets and capital markets act as refinancing systems, not new financing systems. The amount of refinancing is about 4 times the amount of new financing. And in that environment, it's the availability of capital, of balance sheet, that is critical, because that's what's needed to roll over debt. Debt, it doesn't evaporate, it has to be managed, it has to be refinanced. And that's really the background to capital markets and why we see periodic bouts of turbulence when liquidity levels drop. So interest rates are secondary to this whole process. In terms of how we see the world, let me just put these bullets up, which I'll refer to as we go through. But I think there's a number of points that I just want to bring out there. One of those is that liquidity growth is likely to be strong again this year. And I think it's also a theme, if you look forward, that liquidity is going to be likely growing at much faster rates than we've seen historically, really by the nature of the fiscal burden that governments have got themselves into, and the need to stimulate economies, and maybe the recognition that that lots of liquidity growth doesn't necessarily mean damaging high street inflation. We've been very much in the camp that says that the world economy is seeing a V-shaped rebound. I think you just got to go back 12 months and listen to what a number of economists were arguing, that it would be W-shaped, J-shaped, L-shaped, anything but V. V is what we've got. V is what the liquidity data has been telling us, and the speed of economies now is actually eye-wateringly fast in terms of the speed of recovery out of this slump. What's more, economies are basically in sync in a way that we haven't really seen for a long, long time. One of the things I want to focus on is that third bullet point, which I think is increasingly an important point, not just practically, but also sort of philosophically. And that is that maybe our investment benchmarks ought to be monetary inflation, not high street inflation. Now, a lot of people want to try and obviously beat levels of high street inflation. And that really is their hurdle rate when it comes to thinking about asset returns. But maybe what we ought to do is to refigure that and think about monetary inflation. And there are different definitions of monetary inflation, but a very straightforward one is the rate of expansion of central bank balance sheets, or the monetary base, to put it another way. If monetary authorities are expanding the monetary bases of economies at rates of 15%, that should be our benchmark in terms of investment returns. Some assets will beat that benchmark. There'll be rates in excess of 15%, and some will fall short. And asset allocation is really about deciding which is which. I think that's the hurdle we ought to be thinking about. because as we say right at the beginning, all money that's anywhere must be somewhere, but that money increasingly, or that liquidity, is driving asset price inflation, not high street inflation. And that's really what this presentation is all about. And what the rest of that text and bullet points really go through is to say that, we think that you're getting strong performance from equity markets and from real asset markets. Housing is something that's starting to pick up. As we speak, house price booms are occurring around the world. Latest BIS data, the Bank for International Settlements, monitors house price inflation in aggregate worldwide. Their latest data suggests an annualized rate of house price inflation for the world of 10% over the last 6 months annualized. In the US, it's as high as 15% annualized over 6 months. So what you're getting is very rapid rates of house price inflation allied to strong stock markets, allied to areas like gold now picking up again. Bitcoin clearly has had a lot of inflation. These are responses to monetary inflation. Asset markets generally, or certain asset markets, bonds of course not, but certain asset markets are very good hedges against monetary inflation. The other point that you'll see as you look down these bullet points is that we do not believe that China is tightening. That's been a sort of general cri de coeur among a lot of analysts, to fear that China is putting the brakes on. There's absolutely no evidence of that. One of the points that we repeatedly make about China is that China's financial system is highly seasonal, largely because of the fact that it's still, to a very large extent, an agricultural economy, and monetary demands tend to be clearly very seasonal in that environment. But also because the Lunar New Year holiday, which is a floating holiday, tends to distort a lot of data, particularly around the turn of the year. And so actually Q1 is a very hard period to actually judge the true direction of Chinese monetary policy. Everything we see tells us that China is easing gradually. It's not putting the brakes on, as many people argue. One of the things that we've been arguing over recent months is the likely strength of economies in Q2 and Q3 of this year could mean a correction in markets, just because money is being sucked out of financial markets to feed a vibrant real economy, and because we thought it would be likely that taper talk would begin to raise its head again. I think it has. A number of central banks are sort of talking in this direction. The Fed not, but I think it's worth emphasizing the fact that were this a normal cycle, the Federal Reserve, on its own criteria, would already be tightening monetary policy, and it's not yet. It's deciding to push that out. What I want to explore a little bit later in the presentation is, what are the other signs of overheating? What are the things beyond high street inflation that could cause problems? And I think the things that really stand out for us are, number one would be house price inflation. That could be an issue that policymakers want to try and address at some stage. Already, as some of you know, China is trying to tackle that by putting controls on the secondary housing market. But the other factor to watch as well is the dollar. And that's something I think which is particularly relevant. Now, this slide that we're putting up now is a sort of one page which maybe brings together everything that we're trying to say, maybe in one picture or in 2 bits, but in one slide. The chart on the right-hand side, if I just deal with that first of all, that's looking at US debt held by the general public, foreigners and domestic US investors. And what we show here is actually the projections that come from the US Congressional Budget Office right out to 2031. Now, these may well be conservative numbers, but they're still actually quite significant as they stand. The red line is looking at the percent of GDP. The orange is this billions, or in fact, if you read it as 20 or 25 trillions of US dollars of outstanding debt. And you can see that the direction is very clearly upwards. You can see the impact of the COVID crisis more dramatically with the red line. So the percentage share of debt to GDP jumps from just under 80%, around 75%, to almost 100%. But the fact is that it doesn't really come down, and what's more, it starts to climb. And I think the issue that we've got to think about is that how much will US debt go up on a reasonable assumption, because you've not just got the COVID emergency to deal with, you've also got on top Biden's green agenda. You've got on top of that spending commitments for things like Cold War II with China, whatever that may mean, but it probably means more spending. You've also got aging demographics in the US, which is likely to increase mandatory spending programs. So at the end of the day, the pool of debt is going up. Now, that's a worrying factor from the perspective that foreigners have been very big holders of US debts, but the evidence in the last 12 months, and actually even before that, really in the last 5 years, is that foreigners are starting to take down their holdings of US debt. In fact, in the last few months, that takedown has actually accelerated. And in the latest month of data, we see foreigners selling about 60 billion of US treasuries. So this is a trend which is a worrisome one. The chart on the left-hand side may well be the way that that's being addressed. And what you can see there is rates of monetary base growth. Now, this is a slightly, maybe a little bit arcane in terms of the definitions, but simply because a lot of people look at the balance sheet of the central bank rather than the monetary base. The monetary base is really the number that matters most for the financial system. But very broadly, you can take the monetary base to be defined as the balance sheet minus what the government or public sector holds in cash balances. So this is something that in the US is called the Treasury General Account. It was built up in the last year of the Trump administration to pretty significant levels of around about $1.5 trillion. And Biden is in the process of taking that down to circa maybe $500 million. So in other words, there's another, I should say $500 billion. There's about another $1 trillion of cash to go into markets because of that rundown. So if you add together the rundown in the Treasury General Account together with the growth on the balance sheet, that gives you some idea about the potential for monetary base growth. Now, the reason for highlighting this chart is that you can see very clearly the responses of different countries to the COVID emergency. Pretty much everybody, with perhaps the exception of China and to a limited extent Japan, addressed the crisis very quickly. Certainly that was true in the US, it was true for the UK, it was true for the Euro area. Those rates of monetary growth have come back down again, but the US has actually started another pickup. And the red line on the chart is showing the rate of monetary base growth, or if you like, to put it another way, the rate of monetary inflation. And that is something that I think we need to be thinking about consciously over the medium term, because really what it says is that if the US is likely to have a big fiscal burden, a debt funding requirement, and the Federal Reserve is being called upon to finance a significant part of that, the growth rate of the US monetary base is going to remain at high levels, at high rates for some considerable time. And that is creating monetary inflation. It will not necessarily go into high street inflation. That may be a moot point, a debating point. Our view is it probably won't. It's more likely to go into asset markets. And the point, maybe the straightforward point to make here, is that if you're looking at a central bank that is producing these rates of monetary base growth of the order of 15 to 20% year after year, that is the benchmark we've got to look at for asset market returns. Some assets will move faster than that, some assets will be less than that, but that is the sort of growth rate. And it comes back to the statement I made right at the beginning of the presentation: all money that is anywhere must be somewhere. It will not lie idle. Money always gets to work. It will find its way into asset markets, whether that means that the price of gold goes up, whether it means the price of Bitcoin goes up, whether it means that equity markets keep going, or house prices go up, or commodities go up. That maybe is a debating point, but effectively money is going to go somewhere, and that's what we need to explore. The chart that you see in front of you is our sort of centerpiece chart for global liquidity, and it's an index which shows the pool of money worldwide. So this is aggregating everything you've just seen, the monetary base pictures of those big economies, what banking systems are doing, what shadow banks are doing. And this is an index of the momentum of liquidity going back to the 1960s, with some annotations that basically highlight some of the key inflection points that you've seen in capital markets. What we're seeing right now is, after the peak in liquidity, which occurred around about Q4 last year, liquidity is starting to inflect downwards. Now, while it's true that it's better to go up than go down, I don't want to over-egg this point, because think about this as a measure of looseness or tightness. So the peak of this chart is saying that you've got maximum looseness, and the trough of the chart is saying you've got maximum tightness in liquidity. Maximum tightness is a bad thing. Maximum looseness is a good thing. This inflection that we've gone, that's underway now, is telling us that liquidity is slowing down, but it isn't necessarily right at the moment a big negative. As it gathers pace, it will gather pace. As it gathers pace and moves, into next year with more tightness, that's when we've got to be, getting more concerned. But as I'll say a little bit later, at the moment, there's a lot of this cash is sitting on the sidelines, yet to be deployed. There's a lot of cash in bank accounts. There's a lot of cash in general savings accounts, and it's continuing to move in. What are central banks doing? This is obviously a key point right at the moment. This heat map gives us some idea of where liquidity is strong and where liquidity is weak. And generally speaking, the greener the better. Most economies there are green. You can see that if the text is a little bit difficult to read, it runs down on the right-hand labels: world, all developed markets, then all emerging markets, then US, then Eurozone, then China, then Japan, then UK, Switzerland, Australia, India, as we move down. And what that pretty much says is that of the major central banks, the only one that is probably not fully green, probably Pache, Switzerland, but of the other bigger ones would be the People's Bank of China. That's not red, it's sort of greeny amber, so it's sort of in a neutral area, which is what we think. There's a sort of gradual easing process there. It's not as loose as other countries, but generally all those squares tend to be pretty green, saying that most central banks are operating loose policies. What does it mean for economies? Well, this is data, daily data, which goes up to the end of last week, but I think it's illustrative in a couple of directions. The orange line is a measure of economic momentum, and we get that by looking at all economic data releases that come through Bloomberg, as reported on Bloomberg. And we basically analyze those relative to consensus, and then develop a principal component factor, which is reported here, to give an idea of the degree of economic surprise. And that economic surprise is a measure of the momentum of economies. And that's what we show in the in the orange line. And the high level is a very good indication of the strength generally of the world economy right now. And you can see coming out, this is a chart that goes back to 2011, you can see the spike down about a year ago when the COVID crisis hit. But the amount of liquidity that's been thrown into economies ever since, and this is a number which is about $27 trillion in the last 12 months of extra cash, which is equivalent to about 1/3 of world GDP. And that's the sort of the scale of it. That's having a tremendous effect on on markets. And I think you put it in another dimension. You can say, well, look, in the last year, the world basically increased its money or liquidity by 1/3 in 12 months. It took however long you want to say, but maybe 100 years to get the previous 2/3. So just in 1 year, we've basically gone up by 1/3. I mean, this is a huge, unprecedented move. The blue line, which is shown alongside, is a measure of the risk exposure of investors. And I'll say a little bit more about this later on, but this is a measure that we look at. It's daily data. It is measuring investor positioning It comes from a variety of sources. It comes from stock exchange feeds. It comes from custodians, etc. New issuance data as well is put in there, and the flow of liquidity into markets is also part of that compilation. But basically, what it's showing is the degree to which investors are in risk assets or safe assets, and the zero line on the left-hand side, as it happens, is that benchmark. And anything above zero is saying that there's a high risk exposure. In other words, a risk exposure to risk assets. Anything below that is an exposure to more safe assets. Now, the point to highlight here is the scale to which investors jumped out of risk assets and into safe assets at the time of the COVID emergency a year ago, which you can see in that blue spike down. And that was delivered or followed the slump in economies, as you can see in the companion orange line. What's happened is investors have moved back into risk assets, but relative to where economies are, they seem to be below where they should be. So we still think that there's a lot of cash on the sidelines, and given the degree of economic momentum, at some stage in coming months, that money will be redeployed. What about the backdrop for different economies? This is the same methodology. It's looking at economic surprises from data releases. These are principal component measures for different economies. The world is top left. The split between emerging markets and developed markets is top right. You can see there that developed markets have got more momentum than emerging, although emerging have picked up in a number of cases. We've got on the lower left, the US, the Eurozone, and the UK. They're pretty much moving together, as you can see. And then on the bottom right, we've got Japan, Korea, and China. And China is the one that maybe is lagging a bit. Latest data would suggest that that's picking up, pretty much in line with what we're seeing in terms of liquidity expansion in China. But it certainly, in terms of data releases, is lagging some of the other markets. And you can see Korea, Japan basically picking up in probably what is shown there the last month or so. So economies certainly looking very strong. And as this chart here shows, this is different data. This is other data we gather, which is probably more comprehensive in a way, or maybe more conventional, I should say, rather than that. This is looking at the business confidence surveys worldwide aggregated together. So this is things like the US ISM survey, the Japanese Tankan survey, the UK CBI survey, etc. IFO in Germany, and various others. And it's put together in the orange line to show the extent to which economies have rebounded. So there's an awful lot of business confidence out there. We're well above levels that we've seen over the last decade. If you look at the black line, that reinforces the picture. This is world shipping activity. This is an index we compile. It is a combination of shipping freight rates and actually container and transport movements around the world. And what it shows is equally the same picture, a very, very strong rebound. And that is suggesting that world trade growth is going to continue to be strong, shipping rates going up, commodity prices normally get a strong fillip during that period. Markets like Singapore should do extremely well through this kind of period. How does everything relate to the global financial crisis 10 years ago? The blue line on these four charts in each case is showing the GFC. The orange line is basically liquidity conditions. Sorry, I beg your pardon, is the current situation. And we show different measures, as you can see: business confidence, world trade, world investors' risk exposure, and commodity prices. In every case, what you've seen is a stronger rebound, and also, probably as importantly, a much, much faster rebound. If you look at the more conventional economic data, what it's suggesting is that the world economy will claw its way back, or maybe jump back is a more appropriate description. Within 3 years of the recession, it will surpass that in every measure, Whereas if you go back to the GFC, it took a decade to actually get back to levels that we're at. So, I mean, the speed is, 3-4 times faster than we saw after the GFC. And that is testimony to the amount of liquidity that's been thrown in. Let me say a little bit about asset markets now. Anyone that doubts that liquidity is unimportant ought to look at these charts. The bigger one is looking at the change in world wealth. That's measured in terms of all world wealth, including gold, house prices, financial assets, fixed income, equities, liquid assets, everything that's in there in that black line. The orange line is the growth rate of liquidity. The dotted line that runs through to the end of 2021 is just our projections of what the growth rate is likely to be through end year. So it's still elevated. It's not crashing. It's slowing down. The black line is, as I say, world wealth increases. So in other words, take that as asset price movements. And what I've highlighted in the lower right-hand box is what's happening to world house prices. This is the BIS data. And what you can see is that we're seeing the fastest rate of world house price inflation, arguably since probably the late 1980s or thereabouts. So you've got some, very, very significant gains going on in a lot of asset markets. And there may well be a tension, I'm saying a sort of a political or social tension in many economies if house price inflation starts to escalate rapidly. And that will be something that policymakers must be tuned into. In terms of equity markets, this is a chart that we like to show. It's our measure of whether equity markets are expensive or not. There's been an awful lot of talk about bubbles. I don't think there's a bubble. I don't think there's any evidence of a bubble. Maybe in one or two areas you've got that, but I think generally to say that is wrong, because this chart measures the value of all world equity holdings relative to the pool of global liquidity. So if you've got a pool of world equities of something like 70-80 trillion dollars, that is relative to the pool of global liquidity of about 160 trillion. And so you get a ratio of around about 0.5, which is what that ratio is telling us. There's generally speaking been a flatlining over the last few years. There seems to be mean reversion to a level of around about 0.55 or thereabouts on that chart. The bubble periods were Y2K, as you can see, sticking out like a sore thumb when that ratio went right up to 0.85. Ahead of the global financial crisis in 2008, it hit 0.71. With current levels of about 0.57, latest data. The amount of liquidity that's likely to be pumped in through year end is going to take that down to about 0.52. So as far as we can see, it looks pretty comfortable. There's no evidence of bubbles going on according to this data. Let's be a little bit more precise about this and look at it for different markets. And when I say more precise, what we do here is to look at risk assets more generally, to put equities in the context of a portfolio, because that's clearly how they're more usually measured. And the chart on the left-hand side is looking at a mountainscape diagram of different asset classes. You've got bonds there in gray, you've got equities, developed equity market holdings in red, emerging markets are in yellow, you've got liquid assets in brown, and precious metals in black at the top. That gives a pool of world wealth of about $260 trillion. And what we like to do is to look at the division of that between risk assets and safe assets. You can take that very crudely as being bonds versus equities, if you take bonds as the safe asset and equities as the risk asset. But it's that ratio. And the ratio of risk to safe assets is shown on the right-hand chart as the red line. And that puts it into context as to where we are. We're probably a little bit above average, but roughly on that average line. The yellow line is world economic growth. And that simply says that asset allocation is a pro-cyclical process. Investors put more into risk assets during a business upswing. They take money out of risk assets during a business downswing. If you believe we've got a business upswing, then you're going to be seeing more allocations to risk assets, and that's broadly what we think is going on. This is a chart which is well worth sort of pondering over later, but it looks at the world index, MSCI World Index in blue, and the orange line is a combination of our risk exposure data that you've just seen minus the flow of liquidity that's coming into markets. Now, let me just explain why that's important. It's a little bit like saying, you know, if you're filling a bottle with liquid, to avoid an accident, what you've got to watch very closely is, number one, the distance of the liquid from the top of the bottle. So that's risk exposure. And the other one is the flow of liquidity coming in, the flow of liquid coming in. And that's the other thing to monitor. So what we've done here is to take risk exposure minus the flow of liquidity coming into the market as that orange line. And that basically says that if you're at the top of that chart, where you see the top run of 5 circles, what that's saying there at levels of around 50 on the dotted line, that's saying risk exposure is very high and the flow of liquidity is very low, or liquidity is tight. Now, that's an environment where you would expect markets to correct, and you can see there that the MSCI World Index does correct around those periods. It's tough going for equity markets during those phases. Equally, if you go to the bottom of the chart, that's saying during those phases, at the bottom 5 circles are saying risk exposure is low and you've got high liquidity, because we're again subtracting liquidity from that risk exposure index or score, and you're below minus 50 in most of those cases, and those have been extremely good times to buy equity markets. You can see where we are now. We're at still minus 20. In other words, there's lots of liquidity around that hasn't yet been deployed in risk asset markets. So this is our point, basically, that you still likely got risk on moves to a lot of asset classes, and we've got to try and decide whereabouts to position within that. As I said earlier on, the strength of economies and the talk of tapering by central banks may cause a wobble in markets, but this is a buying opportunity, not a selling opportunity. So buy more if markets come back, and that's the view generally on world markets. What about risk exposure in different areas? Where are investors heavily or lightly exposed? What we show here is the track record of risk exposure in US, Japan, UK, and Eurozone. You can see there that the US is about average on that score. The time to get worried about Wall Street is when you get up to the top trend line, and those are periods where the market historically is corrected. The time to buy Wall Street is when you're below that lower dotted line. There have been some great buying opportunities in the past. Probably the best one we've ever seen was, in fact, last March, where you can see risk exposure went right down to those big negative levels. That was the worst or the most negative reading of any market we monitor at that stage. And as I've probably thrown in the anecdote before, one of our clients, Fidelity, mentioned that by I think it was the end of April last year, something like 1/3 of all their clients aged over 50 had sold every single equity they had in the US. And that was the scale to which people panicked after the COVID emergency. Eurozone and Japan are sort of a bit more elevated. And as we'll see in a moment, some Eurozone markets, notably France, are actually at the top of that scale. The UK is way down, and there's a great opportunity, I think, for the UK. Those of you that read Bloomberg and John Authors, he actually put a piece out this morning, sort of hammering the virtues of the UK, or emphasizing the virtues of the UK as an investment, and saying, noting the fact it lagged a lot. Well, that's exactly what our data says too. This ranking shows where we are right now, as of the end of April, in terms of a ranking of markets by risk exposure, on the left-hand slide, the red bars on the right are where we were just over a year ago at the end of March 2020. I'll come on to that in a second, but just focus on the end April data. This is showing a ranking from most exposed to least exposed investors. I said France is very high there. It seems to be that there's been a lot of movement of French investors into equities, and risk exposure is well above normal levels. The red, or the darker red bars, are referring to regional aggregates. So you see the next one down is Asian emerging markets, which is dominated by Taiwan, Korea, Hong Kong, etc. Then you get the Dutch market, which is traditionally quite a defensive market, but again, it's actually been quite elevated over the last 12 months in terms of risk exposure investors. Then we get emerging ex-China, emerging markets generally, including China, about midway down, average of all world markets, about the middle of that ranking. The time to get worried, we think, is when that bar is above the plus 40 index level on that lower scale. That tells us that risk exposure is about 2 standard deviations above normal. Otherwise, most markets are comfortably within that band, so there's not really any great reason to worry. And then you look right at the bottom of the chart, you've got a number of markets there, with South Africa at the bottom, which are basically showing where risk exposure is low. Now, the 3 arrows highlight some big moves in the last 12 months. The first of those shows where the US was as of the end of March 2020. It was the bottom ranked market. You can see how ranking of risk exposure has changed over that time. Almost every market was substantially below their normal risk positioning in equities as of a year ago. Now more above average. The US was right at the bottom. It was at minus 80. You know, if you can figure out, that's something like 3 standard deviations below normal. So that's an extreme degree of positioning. And the US has moved up, fairly significantly since then, but it's still, below average in terms of other world markets. The other market that's moved up a lot are the Asian or the emerging ex-China bloc, which is dominated by emerging Asia. And that's gone from one of the bottom markets towards one of the top, and that's really been fueled to a very large extent by the move in the Korean market. You can see as well with the dotted line where the UK has featured. It was moderately below average a year ago. It's now significantly relative to others below average. The UK has been left behind, but it looks to be, I think, a very attractive area to look into, particularly if you believe in a stronger world economy, because the UK stock market is very representative, or maybe more representative of world markets than many others. Let me say a little bit about commodities in China. This is updating a chart I ran last month as well. What it's trying to show is that the Chinese economy is not dead. It's picking up. The liquidity is going into the market. The red line is our policy liquidity index, which is measuring what the People's Bank is doing. As I mentioned, one of the things that makes it very hard to understand China is the opacity of policy during the period of the Lunar New Year is significant. And there's also traditionally quite a lot of liquidity in Chinese financial markets around this time of year. And what we're seeing is the PBOC is just really leaving it there. Normally what they do is they take it out, they're leaving it in markets, which basically says they're running what looks to be a relatively loose policy. And that's what the red line is indicating. The yellow line is the Li Keqiang index. Li Keqiang is the premier of China, the sort of number 2 there, I suppose. He, some years ago, said very, very pointedly, he doesn't believe in Chinese or GDP data. And I think there's very good reason for that. What he looks at is a number of indicators, things like electricity consumption, steel production, etc. And that was put into an index. This is the Bloomberg version of that, the so-called Liquidity index. It's not a bad measure of the tempo of the Chinese economy. And you can see that that actually is following the policy liquidity index quite closely. The one period where there was a disconnect, which was in 2008, 2009, was actually the period where China engaged in huge fiscal spending, which explains why that yellow line went up and the red line maybe didn't so much. If you want a further gauge of that, you don't believe that the Liquidity index is representative, look at this one, which is the same data, the policy liquidity index again, and we've put on that the CRB commodity index year-on-year change. So that basically is saying, look, yeah, what China does in terms of monetary policy really, really matters for commodity markets and for the tempo of the Chinese economy. And there is, and just for, just to emphasize the point, there is absolutely no overlap in the data that goes into these two indexes. Commodity prices are commodity prices, and the policy liquidity index is just quantities of liquidity that the PBOC is injecting into the system. So it looks as if commodity prices can remain elevated, particularly if you believe that A, the world economy is in sync, and B, that China is continuing to expand. Let me say a little bit about the inflation background and then move on to bonds and currencies. If you take a look at this chart, this is a way that we've disaggregated US inflation. The reason it's important is that what it tries to show is the impact that different factors have had on US inflation over time. The bigger element is US cost inflation, excluding commodities, and that basically is unit labor costs. And principle in that is wage pressures. The red is monetary inflation, in fact, the impact of Federal Reserve balance sheet expansion, if you like. The black area is commodity price inflation, which is effectively energy prices and seasonal products that can affect or distort the index. What that basically tells us is that through the 1970s, when there was a major inflation problem in the US, it was principally coming from cost inflation. And it was sustained cost inflation because of a number of factors, but probably the dominant one was unionization and the fact that wage demands were significant and sustained. And that is true for a number of economies, notably the UK too, but that is no longer such a big issue. There is some element of cost inflation. Cost inflation reached its low points in the decade of the first decade of the 2000s. It's picked up a little bit now. It's running at around about 1 to 1.5% from what we can gather. That's not dramatic, but it's there. And on top of that, you're getting contributions coming through from monetary inflation in red and a little bit in terms of commodity prices. The point there is that what the inflation outlook this year is suggesting is a blip. The figure that we've been running with is about 4% inflation for the year. That seems to be more or less in line with consensus, but it doesn't look as if it's a sustained inflation. And the point here is that what really matters for inflation, high street inflation, is less monetary factors and much more cost factors. What matters for asset markets is much more the monetary element and only a very small amount, if anything, the cost element. So there's a very different balance. In other words, what this is saying is there are different types of inflation, and that's what we need to be cognizant of. Now, one of those is precious metals and gold. And one of the things that I just want to emphasize, and I think I showed this chart last month as well, but it's still very relevant, is that gold is not a hedge against CPI inflation. It's a hedge against monetary inflation. And that's what the data is trying to show. The red line is the trend, the log trend in liquidity. The black line is the log trend in high street prices. And the yellow line, which is the gold price, matches the liquidity trend far, far better than it does the CPI trend. Therefore, liquidity and gold tend to move closely together over the long term. Now, if you run some very simple models of trying to fit the gold market to liquidity, and equally as an alternative benchmark, you try and fit a real interest rate model to gold, what you get is the evidence that we show here. The black line is the gold price, and there's been a little bit of a pickup in the last couple of weeks, which we haven't captured, but it's there, and the black line has picked up now to around 1800. The red and the yellow are showing respectively the liquidity model and the real interest rate model. And what they're trying to do is to predict what the underlying gold price is at any one time. Both of those are giving exactly the same answer right now, to say that the gold market should be about 2200 or thereabouts, simply because you've got lots of liquidity and you've got negative real interest rates. And therefore, you'd expect to see a much higher gold price. Let me say something here about fixed income markets and currencies, because that's the other element that I think we need to deal with. This little matrix is explaining how we understand the fixed income markets and the Forex markets. And what this is basically saying is that we stress, or we put a stress on, emphasis on, the division between different types of liquidity. So it's not just different types of inflation that matter to us, it's different types of liquidity. And we think of central bank liquidity, what the central bank is doing with its balance sheet, very differently to what the private sector is doing with its liquidity creation. Now, private sector liquidity tends to get most of its emphasis or impetus from fiscal policy. In other words, if you get a very loose fiscal policy with a big government deficit, that tends to produce lots of private sector savings, and that makes the private sector very flush with liquidity. Equally, if you look at the central bank, it's monetary base growth or balance sheet growth, which really creates a lot of liquidity. And what we argue here is that if you have very loose fiscal policy, in other words, high private sector liquidity, and lots of central bank liquidity, in other words, high degrees of central bank money, then what you will see is you'll be in the top right-hand part of that quadrant, which is saying you get a steep yield curve and you get rising bond yields. And that's the environment we think we're in right now. If you get the opposite of tight central bank liquidity and you have a very tight fiscal policy with low levels of private sector liquidity, then you get the reverse. You get a flattening yield curve, you get falling term premium and falling bond yields. We're not there, we're in the opposite to that. The other two quadrants are worth thinking about, and that's really the alternatives of saying you get tight central bank liquidity and high private sector liquidity in the top left. So that's a loose fiscal policy and a tight monetary policy in that box. And that's saying that's when you get strong exchange rate. And similarly, if you have the opposite situation of lots of central bank liquidity and you get low private sector liquidity, you tend to get a weak exchange rate, and that's the lower right. Now, one of the arguments that we have been sort of following of late is to say that private sector liquidity, although it's very generous right now because of a loose fiscal policy, more and more of that liquidity at the margin in the US is being spent on imports and it's filtering overseas. So what you're starting to get is private sector liquidity levels going down because it's being lost across the foreign exchanges. And that's meaning that the dollar may well weaken. And that may well coincide ultimately with problems for the markets, but that's something to think about. For the moment, let's look about what the bond markets are doing. Here is a chart which emphasizes that earlier matrix, or it gives an example, evidences the matrix. What you've got there is US liquidity in yellow still rising. It's beginning to inflect, but it's at high levels. And the red line is the yield curve, which is the 10 minus 2-year spread. That's the best measure of fixed income opportunity set. And what that basically is saying is you're getting a steepening yield curve, and that steepening yield curve is being driven by rising longer maturity bonds. That ultimately will peak out, but it's unlikely to peak before 2022. So we still think that yields are rising and they're heading towards something like 2.5% there or thereabouts for the yield curve. So if you take maybe 0.25% for the front end of the curve, you're looking at a 10-year treasury of around about 2.25%. And that's pretty much what we expect will occur over coming months. So yields are backing up. There are limits to that. We don't think you're going to get a runaway yield sell-off for reasons that we probably articulated last month, but that's all about something we call the debt liquidity spiral that I'll come onto if I've got time. But generally speaking, we think that yields have still got further to rise. What about the long-term risks? Well, let me move on to the dollar first of all, and I'll come back to the other areas. In terms of the dollar, this chart is a particularly important one to put us in context. This shows the long-term downtrend in the US dollar since the 1960s. And you can see on that chart 3 visible spikes. Those spikes are basically safe asset demand for US treasuries and other US assets coming from foreigners during periods of let's say turmoil in the world economy, or periods where capital constraints are unleashed. And what we've just come through is a period where there's been tremendous safe asset demand for US dollars and US bonds. That we think is dissipating. This chart, which I know I've shown a few times before, is basically saying here you have evidence as to why that was the case. And it's showing regional capital flows, with the black line illustrating the US or the Americas region, call that the dollar zone, the blue representing Europe or the euro, and the orange representing Asian currencies, call that the Chinese yuan and the yen. Now, what you can see are 3 spikes that we've illustrated there. The first of those is in the mid-80s, which was Japanese insurance companies diversifying into US treasuries. The US authorities pressurized the Japanese into dropping their exchange controls, and the Japanese immediately piled into US treasuries to diversify their assets, and that caused a spike in the dollar. The middle one in the late 1990s was the Asian crisis, where a lot of Asian investors fled into the safety of US dollar assets. And then the latest one, following the global financial crisis, was really driven by 3 factors. One is Basel III and the increased demand for safe assets by banks and insurance companies. The second factor was the euro banking crisis from 2010 to 12, which forced a lot of people out of the euro back into the dollar. And the third of those was the China corruption crackdown in 2015, 2016, which basically caused a lot of money to flee into dollar assets. Now, you can also add to that the COVID crisis, which is the latest blip, but generally speaking, this is an elevated level of dollar buying by foreign investors, safe assets, safe haven buying, which, as we see from this earlier chart, dissipates. It returns to trend. What could cause a return to trend? This is one factor. This is looking at the twin deficits in the US, which are starting to escalate. Now, the data that we've drawn up here, the projections come from the Congressional Budget Office and from the IMF, and therefore they're likely to be on the conservative side. And therefore, I would say that the twin deficits will likely be bigger than this. The red line is the US dollar trade weighted index. And what that suggests is that as you start to see bigger twin deficits, the dollar weakens. That's the normal tendency. And I think those twin deficits are increasing. What's the logic behind it? The logic is that if you've got a big fiscal deficit, it's got to be funded by somebody. And if you've got a rising current account balance, imbalance, deficit in other words, the domestic private sector is basically shifting money overseas. So the ability of that deficit to be funded domestically is decreasing. because the US economy is weakening as that capital flow that external capital flow accelerates. And therefore, this questions the sustainability of US debt in the longer term. And as we saw, that is one of the factors that is there in the background. This is where we stand right now. This is looking at foreign holdings of US treasuries. This is the tick data that comes from the US Treasury. And what you can see is, I think, a worrying picture. One is the left-hand chart shows that in the last 12 months, sorry, in the last 5 years, and more particularly in the last 12 months, foreign holdings of dollars have come right down. They dropped by $1 trillion over that 5-year period, but they've dropped very significantly in recent months. And you can see that highlighted in the right-hand chart, which is looking at foreign private sector holdings of US treasuries, the orange line. You can see how that's come down from about 4.3 trillion US dollars to basically 3.8. So, you know, a $0.6 trillion drop over the last 12 months. And the blue line is the term premium on US bonds. In other words, take that as a measure of the yield on US bonds, a component of the yield inverted. So as foreigners have sold, what you've seen is an increase in term premia. In other words, an increase in US yields. The more that foreigners sell, the more you're going to see term premia and yields rise, and that is an unhealthy backdrop to markets. Now, if the dollar weakens, what does it weaken? What goes up? What does it weaken most against? This is a sort of much unspoken or untalked about fact or chart, which is looking at the Asian dollar. And this is looking at data that we've gathered from the BIS, which is looking at different Asian currency units. And what we've done is to put it together into an index to show the average level of Asian currencies. The pronounced drop in 1998 was the Asian crisis. There's been stability ever since, but you just look at the remarkable degree of stability in Asian units in the last 2 or 3 years. You know, I've said many times before that, you know, in my experience in financial markets in the last 30 years, I've never ever seen the yen as stable as it's been, or maybe you could even say as weak as it's been consistently over such a long period of time. And that must tell us that they're deliberately targeting currencies. And I think that just makes sense for a region where you've got supply chains crisscrossing different countries, and they just need currency stability in that zone. So if Asian currencies are stable against the dollar, what is the dollar going to rise against? It must be the European units. And that's the thing that I would watch for, because I think the ability of the euro area or the ECB to control its currency is de minimis. I don't think there's much they can do. And arguably, there's maybe not much they want to do. They probably quite like a stronger currency, or certainly some countries or some central banks clearly do. What does that mean for asset allocation? Well, let me just finish on these 3 slides. This is a measure of Forex risk. How to read this spider chart is to say the wider you get out on the web, in other words, moving out towards the 90 or 100 index, basically the more risky foreign exchange markets look. The nearer you are to the center, the more robust they are. What does that tell you? It tells us that the Aussie dollar looks a very attractive currency to buy. It says the European currencies, the Eurozone markets equally look attractive. The readings, just out of interest, for Germany, France, Italy are exactly the same as the euro, but they're there, as we can see, for completeness in they complement the following 2 charts. Canadian dollar looks a bit more risky. Asian emerging market currencies, they look a little bit more risky, but that's I wouldn't read too much into that. As I said, we think they're being managed. The US dollar looks a little bit more risky than some of the other units, and sterling looks to be pretty robust, but Aussie dollar sticks out a mile here as an attractive currency, which plays into our commodity theme. What about bond risk? Well, this is basically saying that, look, if you take the yield curve or potential yield curve steepening as a guide to what's the risk in the bond markets, That shows where you've got the greatest risks. In the euro area, they're pronounced, as we can see here. I think that bonds are going to, go to positive yields pretty quickly. What's the best bond market worldwide? China. I think there's, a lot of people are beginning to believe that too. And other bond markets, pretty much of a muchness. What about equities? Well, we discussed that. This is data which is equivalent to the ranking bar chart that we showed earlier on. That basically says, look, where you've got extensions in equity markets are the Eurozone, Asian emerging markets, Korea, sticks out there. France looks expensive in the Eurozone. Which markets look better? Well, you can see that the UK and Canada, Canada commodities, UK, big international stocks with some commodity flavor, again, looking cheap. If you look at Germany, that looks not a bad play within the Eurozone. Italy, even better. US market, around about 11 o'clock there, equally not that extended. So what this really says is that there may be pockets of problems, but generally speaking, world equity markets look pretty well underpinned. And let me maybe finish on that point to see if there's a few questions. But broadly, if there's any correction, we believe that it's worth buying into. There may well be a correction, but there's so much liquidity around, and there's so much impetus from central banks that I think things are going to keep going up for some time. Let me see if anyone's got any questions. You can do that on the chat or whatever. So do put questions in. Let me see if there's some. I can see some on the chat. One about the iron ore spike. Well, okay. I think the iron ore spike is a lot of it's to do with what's going on with China, and broadly the Chinese economy is expanding, as we said. That's what the People's Bank is trying to do. We don't believe the fact there's a tightening going on. China, if it starts to move, is going to demand a lot more commodities. That's at the margin what's driving it. It's clearly there are other things going on with the commodity constellation as well. But I think the fact you've got elevated levels of cyclical commodities like oil, iron ore, etc., is really the story. So I think China is a big factor, but as well, the world economy is very synchronized. There's a question about Brazil. Right, the question, okay. I don't know if that's really a question, but it's basically someone making a comment about Brazil and Canada. But the point there is that neither market looks particularly out of line. Commodity valuations, another issue. We basically think that commodity markets, I think, have got a lot further to go, because at the end of the day, coming back to the broad message, what we're saying here is that all money that's anywhere must be somewhere. It's not going into high street inflation. It's going to drive the world economy faster. The world economy's got a significant tempo. I think there's a great deal of elasticity in the world economy that there wasn't in the 1970s. And so the pressure is going to come much more on volumes. And if it comes on volumes, you're going to get a lot of commodity, price gains. So I still think the commodities look good and commodity currencies look undervalued. So there we are. High street inflation forecast. I think there's a very good point that George Fox makes, which is, what about high street inflation? There's a lot of problems with filling vacancies. And I think that, without looking at or going into the data with drilling down with a lot of detail or analysis, the US employment number that was disappointing last week may not be a demand side factor. It may be a supply side factor. It may just be telling us that what you've got is supply constraints being hit. And I think that the fact is that it's becoming difficult to fill vacancies, which may well mean that wage inflation picks up. That's possible. But I think the thing is here is that are you going to get a significant pickup in inflation in the near term? I don't think so. I think it's more coming in other areas like asset markets or house prices, equity markets or house prices or commodities. And I think that central banks are going to be somewhat slow in reacting to it. So it's possible, but this is not like in the 1970s, for the simple reason you've got a lot more, the economies are more flexible. You've got an internationalization where you can source internationally. And you've got as well not the impact that unions had on sort of trying to force wages up. We've got more service sector driven economies in the West. Question from Ursula about technology: is technology overvalued? Well, I think the answer there are two answers to that. One which I can address and one that I'm not that qualified to address. I mean, if are technology companies able to generate growth and generate earnings? I'm less qualified to do that, to answer that. I mean, I would say, given the environment and maybe given the fact that you've got flexibility needed in economies and you've got shortages occurring, there's going to be a lot more emphasis on investing in technology, probably. But the other question is about the duration of assets. In other words, the PE multiples. Technologies are high or long duration stocks, and if you get bond markets continuing to sell off, then technology is going to underperform, and that, I think, is the basis of a rotation back, towards cyclicals or value. Michael Schul's saying about inflation. Is high street inflation trending higher? I think it is, but I think it's, it comes back to this point that we were making before, that if you look at the components of inflation, which is what this chart tries to show, the mix is very different. I'm not going to say you can't get a pickup in inflation, and the cyclical pressures are highlighted in 2021, but we're a long way back from what was going on in the 1960s, 1970s, where you saw a lot of unproductive spending coming through, and that basically lifting wage levels and causing unit labor costs to spike. At the moment, we've got technology which is helping to keep inflation lower. We haven't got yet the wage increases, so I still think that the background in inflation at the moment is not there, and it's certainly not there sufficiently for central banks to tighten. A question coming from George: strong economies don't mean strong markets, and this means we should have a pullback Q2, Q3. Do I not believe that economies will continue to be strong beyond this, meaning we get a continual weakness in stock markets? Well, I think the thing is that it's possible, but I think the point that what we're really arguing here is that if you look at the response of investors to the business cycle, what they tend to do is they tend to increase their risk exposure through pro-cyclically as the business cycle is unfolding. So as you start to see an upswing, investors will put more into equities and put less into bonds, and that's normally the asset allocation process that we saw, that I think I highlighted sort of back here on this chart. Where are we? This chart here. So this is basically saying that as you get a strong business cycle, what you get is bigger allocations to equities. So there's a case to saying that allocation can increase a lot more. I think that's fair enough, and that's what we're trying to argue. The point about the inflection, a pullback, is really to say that interrupts the flow of liquidity. And it may be a temporary phenomenon, but it's something that one needs to be cognizant of. And so what we thought was there may well be fears of taper tantrums and a big increase in working capital demands that could cause a strain in the near term for liquidity that cause a pullback, and that is a midterm correction that could be another buying opportunity. So I think generally our view would be, as reinforced by this chart, is that there's no evidence of a bubble yet, and we still think that it's risk on. But there may be an opportunity to buy at lower prices in coming months. After all, this is a seasonally weak period generally for markets. The point I didn't make, which is one I just want to mention, is that that the world does suffer from what we call a debt liquidity spiral, which is this this factor here. You get rising debt and you get rising liquidity. Liquidity depends on debt for collateral, and debt depends on liquidity to be refinanced. So the two have a symbiotic relationship, and that's what you get. And basically the problem, the limit to the cycle, is when bond yields rise to such a significant extent that collateral is destroyed, and that's when liquidity turns down. Now, if you look at the long-term pattern of liquidity, we are in a downswing. Yeah, sure. That's what we're identifying. But you've really got to wait until these periods down here towards when liquidity gets a lot tighter to be seriously worried. We've got to watch these charts, but we don't think we're at that point yet. Good. I don't know if there are any other questions. I can't see anything else coming in.
Michael, can I,
yeah.
Stefan, can I ask you a question by voice rather than typing, because it's a tiny phone and it's complicated. How to put it? I don't see, where is the role of reflexivity, or broadly defined the interaction between markets and policy? Because if we just even go back 24 months, the biggest changes, December 2018, March 2020, came reflexively because market prices were prices that policymakers did not like, and they therefore changed their policy entirely to create the market prices they wanted to create. And those are the two events, are the two, that the one everybody can remember because they're the past 2 years. This is all great as far as it goes, but if the dollar goes down 10 reflexively, it's going to change the policy. If the yields go up to 2.5%, 3%, that reflexively is going to change the policy. So I just, can you look at all of this liquidity in isolation without looking at the fact that tomorrow they wake up and change the policy because they don't like it anymore?
Yeah, I see exactly what you're saying, and that's actually one of the things that we've tried to sort of address, maybe not explicitly in this last hour, but certainly more generally. I think to look at those points sort of one by one. Number one is that I think that what you're seeing is a bigger demands on central banks to expand their balance sheets. I think that that maybe that goes without saying. But I think that if you look at the projections for what growth is going to be for central bank balance sheets, looking at the US numbers and taking into account what the Congressional Budget Office in the US is suggesting that the Fed will have to do to buy US debt, you're talking of certainly sort of, high single digits, low double digit growth. In other words, circa 10 to 15% growth in base money over the medium term. Now, that must be a benchmark for monetary inflation. And since monetary inflation is a key component of asset price inflation, that's the sort of figures that we've got to think about. But as you say, there are other forces, reflexive forces that come in and attack. Now, I would say that those are, broadly speaking, two factors in particular. One of those is house price inflation, and the other is the dollar or currencies. Now, at the moment, we're focusing on the dollar because the dollar has been or beginning to weaken. I think that the US administration more or less accept the fact that they would like a weaker dollar, and I think there will be some nonchalance while the dollar drifts down. But at some stage, that will become an issue because it will come back and feed into high street inflation. I don't think that's going to be a factor that is there in the next 12 months, but it may well become a factor thereafter we need to address. House price inflation is more immediate. Already you've got 15% annualized US house price inflation. And although it's not always a political issue in the US because it tends to be more regional or localized, it may be a factor that the Federal Reserve wants to start thinking about. But again, I don't think it's on the agenda probably for at least 6 months, maybe more. On the fixed income side, I think that's an issue that addresses itself. And as I said, you get this debt liquidity spiral where collateral gets destroyed. as yields rise and as the level of bonds, the value of bonds diminishes. I don't think that's an issue until we get to about 2.25%, 2.5% on yields, but it's something to bear in mind. And at that point, you start to see liquidity being tightened more aggressively by the markets because it's more difficult to borrow. But that is on, for example, on this chart here, you'd start to see this red line going down a lot faster. So I think there are reflexive adjustments going on. Partly those are policy related. If policymakers decide to taper because of the factors I said, the dollar or house prices, or you get an endogenous adjustment because the private sector can't lend on diminishing collateral. That's another factor. But I think we're in the early days of that yet. And generally speaking, if you come right back to this earlier chart that I highlighted, this one, you know, if you factor in that drop in liquidity from the sort of the where we are now on the liquidity cycle to where we get to in 18 months time, we get up to about here. So we get up to these levels and that may well be sufficient, but through that period, equity markets may still gain. So, you know, we're not at the tension points that we normally see. And therefore, you know, we're just of the view that this is still a risk on environment. There may well be a correction in what is typically a seasonally weak period in the next few months, but I think that's a buying, not a selling opportunity. And there are some good opportunities being on Wall Street or in the UK market or in commodity producers still. So I hope that addresses everyone's questions. I'm happy to take any more if anyone's got anything. I know I've overrun time, but happy to stay for a few more minutes, but let me know.
Thank you.
I don't know if there are any more in the chat. Can't see anything. Okay, thanks everybody. Looks like there's nothing more. Have a great month. Thanks for attending. Talk to you all soon. Thanks again. Bye.